a few things to make sure you have. I saw a paper today that was missing some pretty critical things. I know these banks pretty well now just because, I knew them real life and then reading papers. So we're not doing credit risk, we're doing market risk. Make sure you define how the bank defines these risks, not how you define it. So don't go up and get an Investopedia definition. How does your bank actually define it? It's not as interesting as on credit risk. The definition on credit risk is much more interesting. How do they measure it? And we'll talk about those, and how do they mitigate it? And your paper should really be organized that way. They define it like this: mitigation. They have, measurement. They have 3 measurements. Bang, 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 bullets, bolded, make it that organized. That helps me, but it also makes it a more organized paper. Maybe I've even start measurement. Wells Fargo has 4 primary measurements that they use for this. Here's the first one. Talk about it. I would do it that organized. And then your conclusion, talking about the overall effectiveness, and then your opinion. You're all doing very large, complex banks. Your opinion. I was talking to one person today. I would probably throw in the one NBD or the well risk or the Wells Fargo. Wells Fargo was more operational than price risk, but I would throw something, if they have these big blowups, kind of makes you question how good is the risk management that a bank like that could have something like that. I just remember the CEO of JP Morgan on the well risk going, oh yeah, I just had no idea that was going on. That's kind of scary. It's that big of a transaction, and he's just not even aware of it. And Jamie Dimon, you would think, knows everything about his bank. On the introduction section, talk about the players, the board, the audit, committees, management. On the committees, I think they're somewhat convoluted, but get some sense of what's going on there. Someone was asking, do I talk about other risks? It wouldn't hurt to have a quick bullet of a few other risks that they have. I think for almost all of your banks, credit risk is the largest section. It's just such a difficult risk. It's probably the most important risk. If you look at 2008, that was really a credit risk issue. It may be a little bit of liquidity, but it was primarily a credit risk issue. So, and then you get into it. So for price risk, you're all going to have stress tests. You're all going to have a few other things that they call all different types of words. I don't really have a big difference between stress tests and earning drawdowns and earnings at risk. They tend to use 3 different terms for the exact same thing and don't explain it. So you have kind of figure that out. They're all going to have value at risk. I can't imagine there's a bank that doesn't have value at risk at that size. A lot of you are probably going to see VAR back testing. That's become pretty common in the last few years. I don't know if every bank will have that, but it's just essentially to say, hey, we said this is a 1% event. How really well is this doing if we go back historically? It's that kind of problem of not using enough history. Now, the duration of assets, liability, net worth, I doubt you're going to see that. Very rare. All the banks do it, but I doubt they actually report it. So that's going to be very, very unlikely. So what you did on exam 1, you're probably not going to see it, but I'm pretty sure the banks are doing that. It's pretty common. So those are the measurements. For mitigation, you're all going to have derivatives. There's none of these banks that don't use swaps and futures. Some of them may even use options, although that's not as common. It's pretty expensive. We're not doing credit risk, so you're not going to see credit default swaps, but I can't imagine any of these banks are not using swaps. They may or may not be using futures, but they're all going to be using swaps. It's a pretty common one. Some of them may talk about internal hedges or natural hedges. Risk limits, I think they're all going to have risk limits. They won't say risk budgets, I don't think. Loan securitization, that's really a credit risk, but that really is a price risk. If you think about a bank, they've got a 30-year mortgage. That creates a lot of interest rate risk, price risk. Securitizing them, getting off the books really does eliminate a lot. So you might do a search on that. So I didn't put the word here, it kind of implied, but correlation is a big one for price risk. I should probably add in there. You should have some tables. So be careful on the tables. I see students that talk about value risk under measurement, and then under mitigation, they have a value risk table. that can make sense because that may be showing the correlation, but the value risk graphs don't really make sense in the mitigation part. So make sure the chart, you should have at least a few charts and graphs. Probably the committee structure will be in there. Liquidity risk, there may not be any charts and graphs there. I don't know, liquidity risk is a mess, isn't it? They're kind of just making stuff up. It's really, really hard to measure and mitigate.
The real value at risk, where is that normally? Because I don't think I could find that, but I found a lot of like asset like
What's your bank?
Bank of America.
They're gonna have it. Do a search on, I would search on space VAR in your paper. If you can't find it, email me, I'll find it, because I'm sure they do it, because they're the bank that usually has the graph. They like to show the graph of the right value at risk. Anyone else doing Bank of America that's finding value at risk? Are y'all finding value at risk? You're not. Well, email me and I'll look for it. I know they do it. Maybe use a different term than value at risk, but it's a pretty common term. All right, so those are kind of things you're looking for, and then your last section, make it interesting. So I'll show you an example of a paper from last year. It won't help you too much because it's kind of out of date, but she did Wells Fargo. She started off with who is the bank in her introduction. Her overview, she talked about, I do like this part of it. If any generic statements, like Caitlin, you're saying, any generic statements the bank president's saying about risk, how important it is. I told you to look at their mission statement. What are you seeing? If I were one of these CEOs, I would have risk in the main mission statement of the bank, because I think that's probably the most important thing they do. The players, you definitely have a section there where you talk about that. Talk about the chief risk officer. I'm pretty sure they all have one now. Do they have a stated philosophy? Do they have a process? The structure and process is usually their committee structure, and she has the committee structure just so convoluted. Just my word. Just so much. Then you have audit committee, obviously, in the board. And then she has interest rate risk separate from price, from liquidity risk. She may not have done liquidity risk because I didn't specifically do that. So measure. So she has a quote from their annual report on what they say this risk is. They have here, she has a definition of asset liability management risk. And then she has a definition of interest rate risk. And then on measure, sensitivity, net income. Here's what we did. This is very similar to what we did on exam, which is the board limit plus and minus. They're only doing plus and minus 100, but certainly she shows that. Mitigation and market risk. See how she has the find, measure. And there she's showing the VAR charts, which you're going to find those. There's Wells Fargo's stress testing, liquidity risk, define, measure, mitigate, and then her final thoughts. So does it look like she left anything out? I think she made a C- on this paper. So no, actually this was an A+ paper. It was a very, very strong paper. It makes me nervous to show an A+ paper because some students are like, man, I'm not quite there, but this was a very, very, very strong paper. You don't have to. The advantage is if you're going to, this is a great paper. I've had several students show this paper in interviews. You want it to look as much like a published journal article, but I don't grade off for it. If it's all, one thing I do hate that I don't count off for, but I hate is double spacing. Double spacing is just looks so horrible. Looks like a college paper, right? How many pages can I make this? That's not how I grade it. So double space is terrible. But yeah, 2 columns, full justified, narrow margins, good use. You notice how her paragraphs are fairly short. I was looking at somebody's paper. Oh, who was it? I can't remember. Oh, it was someone today on this one. It was 2 pages all in paragraph. I can't read that. That's just horrible to read. So you wanted to make it look as much like a published article as you can. Now, most published articles are 3 columns, but you don't want to, I'm 60 years old, so you don't go too small on the font. All right, so this was a very strong paper. Looks professional, very well written all the way throughout. A lot of really good thought. I could tell she didn't just summarize it, she actually thought about what they were saying, if it meant anything. All right, so any other questions on the paper? If you write the paper on the bank you end up interviewing with, it gives you a pretty huge advantage, because you'll know stuff no one else knows about the bank, no question. That's for what? Well, I don't want double space just to add pages. I don't have a page length, but whatever page length makes sense. But if double space makes it 20 pages, and cut it to 10 pages, single space, definitely. And narrow margins if you use 2 columns, because it just gets too crunched. All right. All right, so that's a tough paper. The second paper is much easier. So let's review this, because some of you, after you finish the first paper, you might want to start looking at this one. All right, so I'm waiting to update the file. I'll probably update the file on Thursday, put it out there on Friday. I want to get the latest data I can get. It's a very real life project. Something you might actually do in your first job. One of our entry-level people we hired, he's actually very high ranking at USA now, but he started in my department, so I didn't corrupt him too much. But this was his first assignment, was asset allocation types of analysis that we were doing. So so very real world. It's very conventional. So part of what I want to do in this project, do it the conventional way, but then think about whether it really makes sense in real life to do this, because I did this at USA and I'm always in the back of my mind going, man, we know what we want to do. We're just going to use this technology to back into what we want to do anyway. So, see if that's what you see. So I'm going to give you a file that's going to have a lot of historical data on different asset classes and on different mutual funds. You probably want to save it under a different name, so you have it. There's a video that shows you how to build the efficient frontiers, so you'll do that. So the video walks you through everything you need. The video numbers may be different because I'm not going to update the video when I add 2021 data in, or 2022 data in there. So the numbers may look a little different, and my assumptions might have changed as well. And you're going to do an asset allocation recommendation paper. You got to create a client. The best thing you can do is create a client that's pretty obvious. They're very young, or they're very old, and they're horribly allocated. Those 2 things make the paper much easier to write. So you got a young person who's like 80% bonds, or you got an old person that's 90% stocks, and they're like 100% gross, 90% gross stocks and 10% high yield bonds, or something just ridiculous. That way you can recommend something to them. Oh, there is one issue with that, is constraints. You don't want to have your client violating your constraints, because that can cause problems where their portfolio may actually be more efficient than yours if you get so you want your client to be crazy, but you don't want to be outside of your constraints. And we'll see that when we look at the Excel spreadsheet. So define your client. How old are they? What's their risk profile? I don't need a whole lot there, but I just want to have a sense of who this person is. Most of you are going to be doing for retirement, so that's the most logical one. The assumptions, the easy thing about the assumptions is I'm giving you the assumptions, so you just need to reference that, but it's really important. The assumptions, this is a garbage in, garbage out kind of process. If the assumptions are bad, the entire analysis is horrible. I'm not going to ask you to assess my assumptions, but you do have to say where the assumptions came from. So we always would do that. Where did these assumptions, who built them, who created them, what are they based on? You're using, there's different ways that they stand. So efficient frontier. A lot of people talk about modern portfolio theory, a lot of times when you hear MPT, they mean efficient frontier. That's what they're talking about, not always. You also hear it as mean variance analysis. So if you're trying to look any of this up and Google it, you will hear efficient frontier, modern portfolio theory, or mean variance analysis. When I heard the mutual fund store doing it on their commercial here recently, locally, they use modern portfolio theory. It's been around since the 50s, so I don't know how modern it is. It's 70 years old, but it's still considered modern. I think now we're postmodern, whatever that means, but so that's the theory you're using, which is using mean standard deviation correlation. You're going to find some optimal portfolio. You have a summary of your analysis, which I've done a lot of that for you already. So I already built the graphs. All you have to do is make sure the graph looks right, that you don't have any bumps or bruises in it. And then you're going to come up with your recommendation. I'll show you how I did that in the Excel. What most students do is either, first of all, they have someone who's not well allocated. And so you're going to find a portfolio that has the same risk at a higher return. So that's the easiest thing to do. Some students will have someone who's young with too much in bonds. So you're going to move them from low in the risk to high in the risk, or you have someone that's too risky and you move them down. So those are the three most people do. You can do a portfolio where you say, hey, let's see if we can get the same return and reduce the risk. You can do that. You have to really manipulate the Excel to do that one. So this is pretty straightforward, very straightforward stuff. If you agree with the assumptions, you agree with all the math and everything, it gives you an obvious answer. Well, he does. The question is, do you believe the answers? I think what bothers me the most is the client current portfolio has an expected return of 7.2%. Recommended is 7.35%. I'm going to move into that, pick up 15 basis points. And the back of my mind is that gets lost in the rounding of my assumptions. 15 basis points are really that confident. That's the way this analysis goes, though. It's very, very sensitive. And when you run these efficient frontiers, it will find the optimal point. The problem with that, and this, some of you are going to really struggle with this, I did at UTSA. The optimal point may only be slightly more optimal than another portfolio that's far easier to sell. So you may have a portfolio that's like 40% emerging market stocks, and there may be one that's only 10% emerging markets that's only half a basis point worse. And this analysis doesn't tell you that, unless you put the constraints in. Yeah, that's the other issue I have with this. And that's the biggest thing you have to, and y'all need to mark this in your notes. This right here, you have to have constraints that are different than my constraints. You have to justify that, and you can easily Google that. What's the most you would ever put in someone in the high yield? You can Google that and just see. Typically people say 10%, but is that the right answer? The guy who ran high yield, I probably told somebody all this story, but the guy who ran high yield at UTSA, he liked to graph high yield against our 60-40 strategy fund over time, and show that high yield had a higher return with lower risk than 60% stocks, 40% bonds, which is essentially what high yield is. High yield is essentially 60% stocks, 40% bonds. But would you put someone 100% in high yield? The historical math says, yeah, that makes a lot of sense, but you're not going to do that, because that would, you'd be really, really setting yourself up for a disaster. How much would you put in gold? If that guy I showed you on the environments, he was like 30-40% in gold. I can't believe anyone would do that much in gold. Even the guy that ran the gold fund at UTSA, he would tell his clients, you got too much in gold, you're over 10%. He was, that was his portfolio, and he would tell them 10% is too much, because gold is a very, very volatile asset class. How much in international stocks? Theory says you shouldn't limit it at all. Yeah, I don't know if y'all heard, have y'all heard this phrase, home country bias? You can actually Google that, home country bias. So people in Japan, should probably have 25% Japanese stocks, but they probably have 70-80%. People in UK probably should have 5% in UK stocks, but they probably have 40-50%. People in the US should probably have 50% US stocks, but they probably have 70-80. So we tend to load up on the stocks in the countries that we live. That's called the home country bias. So you can certainly get away with a much higher constraint, I mean, much less limiting constraint international than I have. Emerging is a good one. If you Google that, what's the max in emerging, you'll probably see 10-20% come in or quite a bit. You saw with Michael or whatever his name is, you know, he was pushing emerging really, really hard. He had a really high allocation to emerging. That's a little bit of a stretch. We did the same thing at USAA, and that we got some really big pushback on that. These models tend to love emerging market stocks quite a bit. They do provide some good diversification to US bonds for some reason. So you do need to talk about your constraints. And then we're going to do something you would never do in real life, but I want you to do it just so you can see it. And that's that historical bar I was talking about. I'll show you that one. And I'll give you some responses that you can have, help explain why the historical is so different what you're recommending. But if you think about it, there's a couple of really big things. First is interest rates. And the second is international stocks and the dollar. So your model is probably going to allocate to international stocks. And when it does that, your expected return is not going to look nearly as, it's going to look a lot better than historical returns because international stocks have not done well historically. But the model loves them. Why? Because my assumptions assume they're going to make about the same return as the US stock market, but they haven't. They've made less than the US stock market. So that's a pretty obvious one. Now that's kind of awkward to tell your client, I'm moving you to a better portfolio, however, historically would have done worse. But if you can give some excuse, and that's because, and I've seen people, you know, I can even show you the chart. I showed this at the last, I think I showed y'all this not too long ago. I don't remember which meeting it was. I think it was one before that one. February, February 23rd, maybe. No, that's 2022. Get that. I don't think it was March 1st because that was last week, and I know I didn't do it last week. What came before March 1st? February, right? So I don't see it now. So I had it out there somewhere, but oh, I think I called it markets. Market performance, there it is. So I might have shown y'all this, but so you look at markets versus the S&P 500. When you come to developed markets, they have historically traded cheap to the US market, but now they're what about 10% cheap? Now they're over 20% cheap. So a lot of people are pushing international developed markets right now just because they look unusually cheap. Japan doesn't look all that cheap. Emerging looks a little cheap, but developed. So I've seen several articles. Is now the time to get back to developed markets because they've done so badly historically. Small cap, you know, I'm a small cap value guy because of this. Growth stocks are still overpriced. So, and then interest rates. Interest rates have generally been falling the last several years. So if you go to a lower allocation to bonds, you know, bonds are actually a pretty decent place to be the last 30 years because interest rates have been falling, but we don't expect them to do that. Now they're back up this year. So, you know, we'll see, maybe adding 2022 is going to have an impact. Those are the two biggest things you'll see. Emerging markets have done decently. They've kind of come back, but it's developed markets that are going to look worse in your historical than they will with your expected. So your final recommendation and why, which is pretty simple. Most of it's a higher return at the same level of risk. And then style analysis, I'm a huge fan of style analysis. This is really, really simple. So make it really clear what you're going to do here, because some student could, this is the thing where a student calls me and says, I spent 20 hours on this and I couldn't find the mutual fund. I was like, yeah, you weren't supposed to. 19 hours ago, you were not supposed to. So essentially what I'm assuming here is your client comes to you and say, hey, I've been using the T. Rowe Price Balance Equity Fund. Can I just keep that? Is that all right? You're going to run a style analysis, and a style analysis is going to tell you what their asset allocation is. You can compare it to your recommendation, and you're going to say 100% of the time, no, it is not the right allocation. We can't use this fund. You have to find another. All right. Because there's no, and I've had students out there looking at mutual fund after mutual, trying to find one that has the same allocation as theirs. You're not going to find it. My assumptions tend to load up emerging market stocks. You're not going to see, unless you, maybe Mikhail has a mutual fund out there that you could find, but you're just not going to find one. So the goal is not to find the fund that matches your allocation. Your goal is to do style analysis, which is really, really cool stuff to do. Really quite valuable. To do that, you have to find a balanced fund or an asset allocation fund. I'm going to have probably 10 of them in the file, so you can use one of those. But if you have one that you're interested in, let me know. I can probably load it for you or show you how to load it. I use, you have to be really, really careful on, this is something just you probably should know, because it's pretty, I don't want y'all to make this mistake. I'm sorry, everything I click on, it's just so slow. So you gotta be real careful. Yahoo Finance has the adjusted price. Adjusted price is great for stocks. So the adjusted price, you can use that as a total return because it adjusts for dividends. So if you use the adjusted price, it's the true return of the stocks. Pretty good. You can get an adjusted price, if I could ever show you, you can get an adjusted price on mutual funds. And that does adjust for premium and for dividends, but what it doesn't adjust for is capital gain distributions. And I would show you if I could ever get it to actually go to the file. So the fund I like to use is the contra fund. Well, contra fund pays 4 or 5% distribution in December. So when you pay a 5% capital gains distribution, the mutual fund price falls 5%. That's because you got 5% in cash, but Yahoo Finance doesn't adjust for that. So it makes it looks like, if you do the contra fund for their attribution, it's going to look like they did a horrible job. And so what I do in it in Excel, and so I'll give up on that. What I do in Excel is I use the total return. I don't think I have it in there. I use the total return function in Bloomberg. And you might want to learn that function, because the total return function in Bloomberg, it adjusts for dividends and for capital gains. So you get a true total return. So really, and you can do it for indices, you can do it for stocks, you can do it for mutual funds, ETFs. ETFs have the same problem. ETFs have capital gain distributions that can really cause havoc to your returns. So you want to do that, because if you don't do that, you're doing some type of correlation R squared, and contra fund shows a 5% loss in December when they really had a 2% gain. That's going to really mess up the statistics. So you have to be careful. So it works really well for stocks, doesn't work. So just keep in mind for mutual funds and ETFs, be careful with Yahoo Finance. But you want a balanced fund asset allocation. So I'll build several of them. I'm going to have one in my analysis. I use a Vanguard fund, so that one's off the table. There's other Vanguard funds you can use, like the Wellington Fund and the Star Fund. Those are pretty popular ones. The Wellington Fund is a really famous one because you can get their numbers back to like 1922. It's one of the oldest mutual funds, and it might be the oldest mutual fund in existence. I don't know if y'all know, Vanguard and Wellington used to be kind of the same firm until they split off. So there's some good mutual funds out there. What you might want to do, I don't know how many of y'all have 401k plans, but your parents probably do. You might look at your parents' 401k plan and see if they have a balanced fund in there that you want to use, because most 401k plans have balanced funds that we can find an actual mutual fund substitute for. So if you wanted that, let me know. I can add that. I can add that to the analysis. It's real simple. I've already got it set up in Bloomberg. I bring in the monthly returns and you just use those monthly returns to do the analysis. So it's all set up for you. I've done most of the work. You just got to do the analysis. So you're going to run it. The R squared is telling you, hey, I want the highest R squared possible so that I can really explain what risk this fund is taking. Is it large cap, small cap, growth value, international, fixed income? One thing that can be really helpful on this is after you do your style analysis is go to the website for the mutual fund and pull up its profile and see if its profile is the same as what you just said. If you say, hey, this is 60% stocks, 40% bonds, more than likely that's the kind of fund it is, unless they're just really, really far off. But boy, I wish we had an internet at UTSA. Maybe we'll get one of these years. That'd be nice. I don't know what that picture was. That was pretty wild. Okay, from Dell to Contra. For fun. Yeah, it doesn't. What does Powell know about crypto? That'd be interesting to know what his background is. I'm sure he's pretty knowledgeable about everything, but all right. So when you bring in these historical prices on a monthly basis, and yeah, they may be adjusting now. This is the first time I just noticed that. So they actually have. This is the first time I've seen the capital gains here. So they may have been hearing me badmouth them this last semester. But that's pretty material capital gains, isn't it? $1.14. So I'm going to say use Bloomberg. I just trust it a whole lot more. But yeah, that's good. This is great. So we may be able to use it. I don't know why they have a zero dividend there, but yeah. So you can see why that's almost like 14%, isn't it? It's over 10% in 1 month. So if you didn't include that, you would be in a lot of trouble on the analysis. Yeah, here you can. Yeah, it's hard to tell if they adjust for it because it's sure to drop quite a bit. It doesn't look like they are because it's still dropped from 12 to 10. So yeah, I think they're only adjusting for the dividend, but I'm not sure. So I don't trust them. All right, so balance fund. And the last thing you can do, which is I think the coolest part. Was anyone there tonight? I think that was the only one. Carlos, you're out in the other room, but y'all missed a really good session tonight. Michael, no one was there. Michael took us through the Bloomberg attribution process. Oh my word. It's funny afterwards, like, oh, Professor, he's more hyper than you are. And it's like, yeah, he's a pretty intense guy, a really smart guy, really, really good at everything he does. But he walked us through it. It was really, really interesting. I've got a video of it. I'm going to convert to YouTube. So if you missed it, you might want to go look at it because it's really quite powerful. So so Bloomberg will do what we're doing here. But I'm going to have you do it in Excel so you can actually see what's going on. So it's not, and it doesn't do everything. We're not going to do a full attribution here. So if you've never done attribution, y'all know what the word attribution means. Have y'all heard that term before? It's not often covered undergraduate. So portfolio attribution, pretty good chance, 10-20% of you, this will be what you'll do in your first job because it's a pretty common entry level. So attribution, you're just trying to assess relative performance. So the things we're going to look at, alpha, that one's pretty obvious. What's their return versus their benchmark? What Michael showed us today was it's really cool. UTSA has not purchased the benchmarks. So if you want to compare a portfolio against the S&P 500, we don't own the benchmarks. And I knew we could use ETF. So Michael showed us today, yeah, just bring in the SPY ETF. Oh, that's interesting. Let's bring it in. Oh, it was amazing how it brought it in. The analysis, I kind of cheated. We said, let's build a portfolio. And I put Meta in the portfolio because I knew it was up a bunch this year. And sure enough, our portfolio beat the market by a bunch. That's kind of cheating, right? When you buy a stock historically. But looking at the alpha, so where did that alpha come from? Well, we're not going to do that here, but if you want to learn to do this, you can talk about the source of the alpha. If I learned the Bloomberg portfolio, I may be adding it to this class a later semester. You might want to be adding it to yourself this semester and go learn it on your own. So what we're not doing here is the source of the alpha. And what could that be? Well, It could be sector selection. We saw that. We only put 3 stocks in our portfolio. Microsoft, Meta, and somebody else. Forget the third one. They all did really, really well. So we kind of picked a really good portfolio. But on sector selection, it's we beat the market by 10%. So we had 10% alpha. Okay, so we cheated because we put Meta in there. Well, then it said sector selection. Well, sector selection was 2% of that 10%. So 20% of our performance is because we picked communication services. Because that sector outperformed. Now, why did that sector outperform? Because Meta is in communication services. So we, again, cheating. And then it said security selection. Well, net Meta was 70%. 7%. So Meta was almost our entire outperformance. But I will show you this stock. What I really love and what you can do in this, you can say, okay, our portfolio beat the market by 2%. Here's where it came from. Here are our top 10 contributors. Here are our worst bottom 10 distractors. How much of your return came from picking the right sector? How much of your return came from picking the right stocks? You might find that, boy, you're really, really bad at picking sectors and you're really good at picking stocks. So maybe you should just be neutral in sectors and be a stock picker and don't try to be. And there are managers out there that try to be neutral in sector. And technology is 30% of the market. We're going to be 30% technology, and then we're going to try to pick the right tech stocks. So, and we're talking today in the REIT sector. There's 2 REIT managers we hired. One was a sector person. They had a bunch of economists, and their goal was to pick the right sector. Do they do office, retail, hotel? That was their goal. They were high level, top down. The second group were a bunch of stock pickers. They didn't care about the sector. Their goal was to get the right stock. So I would expect that first group to have all their alpha coming from sector selection, and the second group getting all their alpha from security selection. If I did their attribution and that wasn't the case, it might kind of clue me in that they're doing something they're not telling us. What else could you have? Well, you could have country selection, and you could have currency selection. And then you have this last thing called interaction, which I hate interaction. Michael was saying it's not as bad as it sounds, but interaction is essentially the plug to get you to your difference in performance. And it just means sometimes they interact with each other in a way that you can't really separate them. For stocks, not a big issue. For bonds, interaction tends to be the biggest number. So it's a little frustrating that other is that big number. But you can do all, and you can even go down to industry. You can go to risk. You can say, hey, did we outperform because our beta was too high or too low? So you can look at beta, vol. Michael's saying, yeah, you can rank. You can sort your portfolio by volatility. You might find, hey, this was a low vol market. Stocks with low volatility did a lot better than stocks with high volatility. Or this could be a low risk market. Stocks with low beta did a lot better than stocks with high beta. So value really outperformed growth. We were heavy on growth stocks, so we underperformed. You know, there's all different ways you can cut this thing down. So we're not doing that in this analysis, but you can do that in this analysis. It really is a really cool thing to do. We're using Bloomberg, but you can use Bloomberg, FactSet, Morningstar. Y'all probably familiar with Morningstar, I bet. I've heard of Morningstar, and they do a lot of this type of analysis. Those are the 3 big ones. We have access to Bloomberg. I don't think we have any. We don't have any FactSet. I don't know what we have Morningstar wise. Do we have any Morningstar at UTSA? Anybody know? Seen any? So I should go on the library and click on him and see if they have it. But we do have Bloomberg, and we were excited, man. We had like 7 people in there, and they all left. They're all pumped. It's like, man, I can't believe we just. And Michael was going fast in 15 minutes. He was moving very, 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 very fast. And it was just really exciting. We're kind of worried with spring break. We're going to come back and can't remember any of it. I haven't used Bloomberg portfolio for 14 years, and it's very different today than it was back then. But really, really cool stuff. But it's not user friendly. You don't pull it up and say, "Oh yeah, I'll just do that." it's not obvious which button is to push. So so the videos can certainly help. Then you're definitely going to look at risk, things like beta and tracking error. I think I asked y'all what tracking error is. Y'all remember, did we talk maybe about other class? Yeah, I know what beta is. So you know portfolios have beta too, right? Not just stocks. Stocks have betas, but portfolios have beta. What beta is it? Well, it's going to be that regression beta from the last 5 years, which, you know, is kind of interesting information. Anybody know what tracking error is? Y'all heard that term before? So we're going to talk basis risk as another risk after credit risk. It's a similar concept, but tracking error is the standard deviation of alpha. Deviation of alpha. So you take those monthly alphas, you take the standard deviation of that, and that's your tracking error. So essentially what you're trying to do is you want to know, was the alpha due to luck or skill? So if you have a really high tracking error, so you're solid, sometimes you win by 10%, sometimes you're down by 5, sometimes you're up by 20. Good chance it's just pure luck that you just happen to end at a month where they were way up, and the next month you're going to be way down and you'll lose it all. If the tracking error is really low, then it means there's probably skill there. So that's the thought process there. So definitely know what alpha is, definitely know what tracking error is, really important. And then you have what's called the information ratio, which is, anybody know that one? So the way I do it, I'll give you the way I do it, is annualized alpha divided by monthly tracking error. That's the way I always calculate it. It's not two annualized numbers, it's an annual number on the alpha divided by a monthly number on the tracking error.
So when you were talking about Bloomberg, FactSet, and Morningstar, were those like what you use to find the sources of alpha? Like
Oh yeah.
Okay.
Oh, yeah. And Michael tonight was like, man, I show you a million more things. He loves helping people, so he's like, I don't want to leave. There's so much more I can show y'all. Is, you know, and he was like, I'm not even scratching the surface. It's pretty amazing. When he clicks on the box of what all they can look at, it goes on forever. In fact, the box is a box that each thing on the box is another set of boxes. I mean, it's like so many things you can look. A lot of it's stuff that's probably not all that useful, you know, that you ignore, but it's all sitting there for you to try to figure out what can you do with it. So yeah, pretty amazing. The other nice thing about Bloomberg is they have preset analysis. So they have like 20 or more, I don't know, a bunch of those where you can say someone's already built this analysis. You can just click on that and it comes up. It takes it like 30 seconds to load. Pretty amazing stuff. So some of y'all might, you know, maybe I'll give extra points if some of y'all go do this on Bloomberg, because it would be pretty amazing. To do it on Bloomberg, I don't think that you can do mutual funds, but the amazing thing on Bloomberg, if you click in an ETF on Bloomberg, it brings in all of their holdings, just like any other portfolio. So you could bring in an ETF that's an active ETF, and you can make that your portfolio, and you can bring in another ETF that's an index, and that can be your index, and you can compare the two. So contra fund, I don't know if there's an ETF for the contra fund, but if there were, you could do an entire analysis in Bloomberg. It would be pretty cool. I'll try to get that video out over spring break so you can look at it. So information ratio, think like a T-score. Or that's the way I think about it. It's like a T-score. You know, T-score is trying to tell you, can you reject the null hypothesis kind of thing. So you're looking at the difference over the standard deviation of difference. And you're going to say, well, is that difference statistically there or not? If the difference is a small number and the standard deviation is a massive number, you probably can't reject the null hypothesis. You probably can't say there is something there. You have to say, yeah, there's a good chance it's just pure noise. So I don't think information ratio is technically a T-score, but it's that kind of thing. You're trying to figure out if there's any statistical significance there. And then we talked about batting average. I love batting average. Very simple. Percentage of months outperform over total number of months. Pretty simple. So if a firm has a really large alpha, but their batting average is low, then you know they probably had 2 or 3 really killer months, and then everything else. So batting average is similar to tracking error. The difference between batting average and the information ratio is that this has no predictive ability, and this has predictive ability. I think I showed you that last class. So of the two, at least the last time we did it, has been a while since I did it, but when we did a detailed analysis, batting average, if you use that to pick managers, has more information than the information ratio. We used to use the information ratio because we said, hey, that's what we're after. Does this manager have true skill? And the information ratio, the traditional is greater than 1 skill. That's traditional. You have an information ratio greater than 1, then there must be skill there. So your alpha is 2%, your tracking error is 2%, your information ratio is 1, then yeah, you've got some skill. A lot of hedge funds that I've dealt with, they have a target information ratio of 1. That's what they're targeting, and they'll actually put that, in their prospectus. Whether they accomplish that or not, only time will tell. And then my other favorite is the upside downside capture. I think I showed y'all this last class, but on the upside, it returns when index is positive. So your portfolio returns when index is positive divided by returns the index when index is positive. And then that's the upside capture. And then the downside capture is just exact opposite. The key here is when the index is negative or positive. So if your fund has a negative return when the index is positive, you're going to put that in the positive upside. If your firm has a positive return when the index is negative, you're going to put that on the downside, right? So the index defines whether you're up or down. And what generally you want, it'd be great if, this would be great to be 104% and 92%. That'd be great. When the market's up, they're up more. When the market's down, they're down less. That would be wonderful, wouldn't it? How many funds do you think can do that? What's their beta? Their beta is above 1 in good markets and below 1 in bad markets. That's a pretty good shifting manager. What you'll know, normally I think on contra fund we'll find is something like 98% and 94%. So in good markets, they kind of get most of the market, but not all of it. In down markets, they save you on the downside. You might find a firm that's 108 and 104. I doubt you're going to find one that's 100 and something on the upside and negative 90 something on the downside. That would just be really tough to do.
Sorry, what was the like normal metric? You said like 98% for upside capture.
Well, it's going to, most are either above 1 and above 1 or below 1 and below 1. Most of them are going to be consistent. I've never seen one that's above and below. Now, a below and above, that would be like going out of business kind of fun. That would be just the worst. The market's doing well, they don't do very good, but when the market's down, man, they're down a bunch. Would just be the worst case scenario. This doesn't have statistical significance, but I still love it because I think it tells you a lot about what the manager is doing. It gives you great insight to their strategy. One thing I loved about this especially is when the managers came in and explained their process, there's times where it's like, man, your process shouldn't give you these numbers. That just doesn't make sense to me. There's no way. And we had managers come in and talk to us, and it was pretty obvious that their pitch book was written by the marketing department who'd never talked to the portfolio managers. They went out and got some generic. It's like, yeah, you're not doing any of this. This isn't, your numbers aren't reflected. We've had managers where you can just tell from their analysis, this is a high quality manager. This is a manager that does horrible in junk markets. Oh, you outperformed in the last junk market. Wait, that doesn't make sense. How did there's no way your strategy should have done well in that year. And you can kind of push back. So this kind of stuff really gives you some great insight. And then after that, you got to pick a few: Sharp, Trainer, and I don't know how to spell Trainer, and Jensen. Pick one or two of those. Trainer and Jensen are the easiest. The Sharp is a little bit of a struggle. So Sharp is, you're taking your returns and dividing by the standard deviation, but you're taking returns. Anybody remember the Sharp ratio? So your return, any takers? That's the risk-free over standard deviation. So you've got a big problem with Sharp is that now you need another set of numbers, which is the risk-free rate. So what is the risk-free rate? So if I were you on the risk-free rate, I might use like the 6-month treasury yield. Find something simple that can work. It's find something you can easily pull down. You really can't use the 5 or 10 year because they are going up and down in price, but that's not captured in the yield. So, but there are ways you can find something that's a good proxy for a risk-free rate. Essentially what he's saying is how much did you get over the risk-free rate versus how much risk you're taking. It's kind of similar to the information ratio. Trainer and Jensen, they bring in beta. So essentially they say the definition of risk is beta. It's not standard deviation. So they're trying to figure out, given the systematic risk you're taking, are you adding enough extra return to justify that? I do have out, and well, I'm scared to type on this again. Let's see if it will let me in. I did put out there under files for papers a file that gives those definitions in case I forgot. So the Sortino, I forgot about the Sortino. You could certainly use that. I don't like these ratios. We never use any of them except for Sharp. I don't remember seeing them anywhere, but they're covered in academia, and there's a chance you'll see them in a job. Of course, nothing happens. Yeah, is it still loading? I don't know why it's still loading. So Sharp is the return of your portfolio over the standard deviation minus the risk-free rate over the standard deviation of your portfolio. This is all annual numbers. Sortino is real similar, except for Sortino, you can take some calculation because it's only looking at the downside. So essentially what it's saying is when your stock is losing money, what is the standard deviation on those days? So it's a little bit kind of a semi-variance kind of thing to do. So standard deviation on the downside. And this was a big debate. I don't know if y'all heard this term semi-variance. Has anyone heard that before, semi-variance? So you have standard deviation, which you don't care if you're above or below the mean, you just want to know how far you are. Semi-variance is say, hey, I'm worried about risk, but only on the downside. So tell me how far away I am when we're below average. So that's the semi-variance. Supposedly, Markowitz, who came up with the efficient frontier, wanted to do semi-variance. He wanted that to be his risk measure, but it was just they didn't have computers and calculators, so it was just too hard of a calculation to do. And so he went with standard. I don't even know how to do standard deviation back then. Then several years ago, I don't know if this guy is still alive or not, a guy named Brian Rahm, to see if he comes up here at all. But Brian Rahm, he wrote an article for the Financial Analyst Journal saying we should be using semi-variance. It's a much better measure. And Roger Ibbotson disagreed, which is pretty scary. You don't want Roger Ibbotson disagreeing with you. And so the two of them had this debate in the Financial Analyst Journal. Would one would write an article, one would write an article, the next one, he would back and forth, back and forth. There he is right there. That's probably the same guy. Investment technology. So he's still in business. Modern portfolio theory comes of age. So the poor guy, he's debating. I mean, Roger Ibbotson, this is like Dr. Ibbotson. This, you hear his name, he's like the guru of the efficient frontier. And this poor guy is, I mean, a very public debate. So Brian Rahm, and so I called Brian Rahm, and something I really highly recommend that you do. I was really shy, but for some reason, if I read an article I really liked, I went and called the article. I just, the writer of the article. I don't know why I did that. You would thought I was too chicken to do that, but I was like, my thought was, what can they do to me? They can hang up on me, but beyond that, what else are they going to do? They're not going to remember my name. I've had some people really mad at me that they called, but they still answered all my questions. So they're like, why are you calling me? It's like, yeah, I just want to know these 3 answers. And they're like, well, okay, but why are you calling me? He wasn't. But here, oh, sorry. I didn't want to, am I in his LinkedIn? So I called him. He wanted to talk because this is USAA. This is a big company, and he's trying to sell this new product. Unfortunately for him, he explained it to me in a way that we could have done it ourselves. We didn't need his. So I just did everything he said, and we just did it in Excel. It's really easy to do. So, but it was really interesting. So I kind of, sometimes you do that. You can. It's not really dishonest. It's because it's possible I could have bought his product. I wasn't completely dishonest about it. But he explained it. He kind of over-explained it to me, and I don't know why it keeps doing that. I love it when LinkedIn sends me an email and asks me if I know Professor Sweet at UTSA and I want to become friends with him or whatever. And it's like, yeah, I know him pretty well. So that's the semi-variance. His argument was we only care about the downside. We shouldn't look at downside risk. Dr. Ibbotson's argument was, yeah, that doesn't work. Look at the Japanese market in the 70s and 80s. All the variance was on the positive side. You would have thought that was the lowest risk market out there. And when it crashed, you sure wanted to see the full variance because you weren't getting this. So that was his argument. The two of them went back and forth. I think Dr. Ibbotson probably won the argument, but who knows? That's years and years ago. But I don't know. I respected Brian Rahm for taking on the challenge, and that's pretty gutsy to do that. I would have never done that. But that's where the sort of ratio is. Hey, if you're worried about risk, let's just worry about it on the downside. Let's don't work on it because there are managers that are downwards. Their skew is to the negative, and you would want to know that skews to the negative. If you have volatility because when the market's up, they're up a bunch. It's like, well, great, that's wonderful. We want that. So Trainer uses the risk-free rate as well. So I guess Trainer is exactly the same as the Sharpe ratio. I forgot that they subtracted risk-free rate. So Trainer is exactly the same as Sharpe ratio, except for they use beta instead of standard deviation. So that's pretty easy to remember. And then Jensen, essentially what Jensen's trying to do is say, where is your return versus capital? So Jensen says, hey, this is your return on your portfolio. Given the beta of your portfolio, this is return you should have gotten in comparison to. So again, you need the risk. I forgot you need risk-free rate for all 3 of these, so it's kind of irritating. So they're all trying to look at excess return relative to risk to try to see if there's some performance there. Now, I've seen many presentations in my life, and I've never seen Sortino. Well, I may have seen Sortino once or twice. I've never seen Trainer. I've never seen Jensen's. The only time I see a Sharpe ratio is with a hedge fund. I've never seen a Sharpe ratio with a mutual fund or portfolio manager. So Sharpe ratio, I know it's pushed. Have y'all had it in your classes? Any of your classes? None at all? Well, some of y'all have made a mistake of taking me too many times because I don't cover it because I don't agree with it, but it's usually textbooky stuff that they always cover. Like I think some academic professors cover it thinking the entire world uses it and don't realize very few people actually use it. Same thing with the capital market line. Y'all probably heard that. And we don't, I didn't find anyone to use that. Security market line, I don't know anyone that uses that, but we teach it in the college level. I don't teach it in my classes. Right, so these are kind of things you're looking for. What you want to do in this last part is you say, okay, your client came to you with another portfolio. So they came to you with this balanced portfolio. And you say, hey, I did a style analysis. The allocation is far too different from what I'm recommending. So no, you can't do that. And they say, okay, well, you don't like that manager. Well, I've got this large cap manager. Could I use this large cap manager for my large cap allocation? And then you're going to do attribution and say, yeah, they perform pretty well, or no, they're not very good. This is one, especially you should look at your 401k plan or your parents and send me a name, because they probably have a fund manager we could use for this analysis. So look for one, then you can go home during the summer break and tell your uncle he's a really bad investor. Like, hey, uncle, you know that fund you sent me, do you know how bad that thing is? Can you look at these numbers? They're just a horrible fund. Give the money to me, I'll manage it for you for 1%. So that's the project. Now, if we look at the actual model, I'll show you the model from last year, because I'm going to update this one. So you can see this is a fairly straightforward project. It's obvious what to do in each section. So I really just want to give you exposure to some pretty basic stuff. We'll do this tonight, and we probably do it a little bit into Thursday night as well. All right, it's going to probably take forever for it to load. All right, so you see what you have: an introduction to your client, assumptions, constraints, run the fresh frontier, historical VAR, style analysis, attribution. You have a final recommendation at the end. You'll be doing a pretty common technique for most financial financial advisors. The advantage you're going to have is you're going to do it in Excel and see the whole thing work. Most financial advisors, it's a black box to them. They're just selling whatever their company gave them. So if you meet with them, it gives you a huge advantage. And I love doing that. Boy, there's a lot of times I go with my brother to these kind of meetings. There's people at my church that calling with tears, like, I don't know what to do. I'll say, I won't give you advice, but I'll go sit with you when you hear the advice and all the horrible things. I remember this one planner, I knew what he's doing when he did it, but he goes, I charge 1.5%. So, if you give me $100,000, I charge it $1,500. And I knew why he was doing that. So we leave. And she goes, well, he only charges $1,500. I said, no, you have $1 million. He's going to charge you $15,000. What is he going to do for $15,000? And almost nothing. He's going to make $15,000 to plug you into a system he's got already built for 50 other people. It's not going to cost him hardly any extra time, and he's going to get $15,000. But why was she thinking $1,500? He knew she had $1 million. Why didn't he say 15,000? I mean, isn't that deceptive? Don't you think? Should he told you I'm going to charge you $15,000, and then she could ask, what are you going to do for $15,000? What, you want him to work at least a couple hours for $15,000? So, all right, come on, Nicole. There it goes. All right. I could tell you so many stories. Those in my life insurance class, they heard the what was her name, Darcy? What's her name? Don, yeah, that's my favorite one. That poor lady. I mean, it's my favorite because it came out good in the end. But she was literally in tears. That poor lady was so abused by our profession. All right, so when you load up this file, it has different pages. The first page is the assumptions. So blue is the assumptions. I give you the assumptions. Return is essentially a current yield plus earnings growth for stocks and current yield for bonds. For gold, I just stick in a number for maybe inflation. For bonds, I'll definitely be changing my assumption for bonds, no question, because interest rates are up quite a bit. For high yield, yeah, high yield definitely much higher than today. Now, high yield, I don't use the current yield. I use the current yield on bonds. High yield is a current yield minus defaults, because if you buy high yield, you're going to have defaults. So there's an adjustment there. Risk is standard deviation, and it's essentially heavily reliant on history, which is what we did at USAA as well. And then correlation is heavily reliant on history as well. Now, my correlation table is not positive, definite, adjusted, because I don't know how to do that. It's really difficult to do that. We had software packages that would fix the correlation table, but would do it in such a horrible way. And they take this 0.79 correlation and change it to 0.61. They radically change it. And so the guy at USA fixed it so it wouldn't make those massive changes. So you're just using my correlation table. So, and then the green is where you're going to spend most of your time. The green is where you're going to run the model. And I'll show y'all Thursday how to actually run the model. And then by Friday, maybe Thursday, I'll have the actually updated model going. So the green is where you're going to run. Here's your asset classes. So we have 9 asset classes. Large cap, US large cap growth. So these are the tech growthy kind of companies. Large cap value. Those are the cheaper kind of utility kind of, cheaper stocks. Small cap growth and value. So right now I'm kind of a small cap value kind of guy. Developed markets. Emerging, see what I said? It loves emerging. Gold. And by gold here, I actually mean gold itself. At USAA, we had a gold fund, but it didn't buy gold. It bought companies that produce gold. Very, very, very different. In 2008, gold was up, gold stocks were down. So our fund was actually negative in 08 when everybody else, everybody's hoping they're going to be saved. Bonds, by bonds here, remember, by bonds, I mean mainly corporate bonds. This is not treasuries. So I'm trying to be honest with what we actually do. And then high yield. And then I'm gonna have my constraints. My constraints are maxes, but you can add other constraints if you like to, or you can use this. The only thing is you can't have 20, 10, 20, 40. So you got to figure out something different besides those. By international stocks, I mean emerging plus developed. So it's the two of them combined. So if you look on the actual, it's adding 2 numbers together. So the green, we're going to be spending some time on the green. And then the bottom part is all the calculations. And this formula should look really familiar to you now. I won't ask you if you know it. You'll always depress me when I ask that question. But that formula, weight squared, risk squared, weight squared, risk squared, two risk, weight, risk correlation. And the way I do that is I do the weight squared, risk squared first, because that's the easiest. And then I do the 2 times weight, risk, and correlation. And that you have to do every possible combination all the way down. And that gives you the risk. The return's really easy. It's just a weighted return. So that's what this model is doing. What you're trying to get to is an efficient frontier. So you're going to build an efficient frontier. You'll build a client. I'll show you how to do that. You'll have historical VAR. So look here, my portfolio, look how awkward this is. My portfolio is going to be higher return at the same risk. When I go back historically, my portfolio had a lower return with a slightly lower risk. So it was supposed to be higher return with the same risk, and instead it was lower return with the same risk. How do you explain this to your client? Well, how do they do it in practice? They never show this. That's how they do it in practice. But you should always ask this. If they say, I'm recommending going to this portfolio, hey, how would that have done versus my portfolio the last 30 years? What are they going to say? They say, I can't do that for you, and they should be able to do it. So you should always ask that question. Not that, and one of the reasons why is here, probably it's the emerging markets on this one. I'm going 20% emerging markets. They didn't do all that well. And so I would have been better off in US markets, but I'm saying going forward, you're going to do better in emerging. That's an awkward thing to explain. Well, why do you think that? Well, because they're high risk, they should have a higher return. That's not a good answer, right? And then you'll do the style analysis, and I have a graph on the style analysis, and then you'll do the manager attribution, and we'll talk about the manager. And this is all the funds that I've set up, but I can set up more. And all you got to do is just pick one of these for a balance fund and pick one of them for active, or send me more. So think about it. Or, if you see family members or whatever, or email them, say, hey, send me your 401k plan. If you have a 401k plan, you don't know how to interpret it, then send it to me and I'll find a stock for you. Some people like to do for their client. They like to do their 401k, one of their 401k plans for their client. We can do that as well. So I've had several students send me their 401k and we set it up in here. All right, so I'll stop there, but we'll get into this more on Thursday so you can, after you turn in the paper, you can start looking at it. All right, let's start. So we did balance sheet immunization on exam 1, and now you're doing your bank risk. Does it sound important at all after today? So JP Morgan was down 5% today. SVP, have y'all even heard of SVP? They're down 60% today. They're down 22% overnight. Maybe we'll do this as a case study if it depends on how complicated it is. But y'all are discovering your banks are pretty complicated. But what happens when they're so complicated they mess up? You're down 60% or another 20% in 2 days. You can kind of see it in the history. So was this more credit? Was it more? If it's credit, then it's liquidity and credit. It looked like it was more liquidity and credit, but I'll have to read about it. John Tui sent me a couple of articles on it. I'll have to look at. I don't know if he talked about it much in his class, but not a huge organization, but $212 billion in assets. That used to be, right? Tells you how amazed I was when State Street went over 100 billion. Thinking, wow, I can't believe there's a bank with 100 billion. They've got 200 billion. I'm thinking, oh, that's 1/10 of the size of the big banks, but still a pretty good size institution with only 16 billion in net worth. Yeah, so this is important stuff. So we'll see if I can find out enough to talk about it. We'll see what happens in the next few days. You're seeing this same thing going on with China with some of their bank loans and some of their banks institutions, people thinking it can bring everything down. These are pretty scary organizations. All right, today I want to, since you have your bank paper done by Monday, if you want to get a head start and start working on project 2, which is the easier project, you really want to get a high grade, especially if you struggle on the exam or the paper, you really want to get a high grade on this. It's not a really tough one. So I have updated it. So the first page is the model. The second page is the model output. I'll show you how you can work with that. Then you get into first and frontier. Then you'll do historical VAR. Then you'll do style analysis. And then you'll do manager attribution. So I'm going to walk you through this. You also have a video that does it, but I want to walk you through it so we can talk about the theory behind all of this. So there's certain returns that I have. We assume growth will have a higher return than value. Small cap will have a higher return than large cap. Developed will be about the same return as large cap. Emerging will be about the same return as small cap. That's just a traditional. Gold, I put 4% on gold. Who knows? Gold, you can look historically at gold, but the main key with gold is it's probably going to do something similar to inflation, although the dollar has been a big issue here. Bonds, I use the current yield, and then high yield. Now, I did not use the current yield for high yield because if high yield's yielding 6.8%, you're not going to get 6.8%. You're going to have defaults, so you have to subtract some level of default. So I just use the historical default rate there. Then risk, very much related to history, but essentially return and risk are related. I had a boss that said they should be perfectly related, such that these numbers should be real similar all the way across. But you'll notice that's not really the case. They can be quite different. And why? Well, because there's correlation. So gold looks ridiculous, but that's because gold's a diversifier, so it doesn't have enough. And bonds look great, but that's because risk is not a linear thing. So there's really no reason. His idea was let's keep all these things in a similar relationship, and there's really no logic that would have to be the case. Correlations are based on history. You can see all the stocks are fairly highly correlated with each other. I have gold as positively correlated with stocks. That's based on history. That can be a big debate. I know with the gold guy at USA, he would go, he had, I forget what his factors were. I should have kept track of that because he's a smart guy. One thing was the dollar. What's the dollar doing? If dollar is going to be weak, we're going to want to do gold. The second thing was the stock market. His idea, if the stock market's strong, gold is going to be a bad place. So he essentially had a negative correlation on gold. His other factors were very gold specific, supply demand kind of things. What's going on in India? What's going on in South Africa? Places that are really important to the price of gold. So, and then bonds. We had that debate: are bonds positively or negatively correlated to stocks? And that's I have them essentially at 0 there. And then high yield, essentially highly correlated to stocks, not as correlated to bonds as they are to stocks. High yield is more like a stock than a bond. But all of these are based on history, and you can look at the history. It's in there. And we saw this earlier. You look at the correlation of large cap to emerging. It's a pretty wild ride. All right. So decades ago is very, very low correlation. Emerging markets were a tremendous diversifier, but last several decades, it's been about 0.8. Now remember Mikael, he's talking about how emerging uses but 20% in emerging because it's this great diversifier. It's been somewhat of a wild ride. I don't know why that disappeared, but okay. So you have this spreadsheet. So what you're going to do, and you'll see it in the video, but this first row is pulling stuff from the first page. So whatever you do on the first page is going to this first row. Your goal is to get this top line down here somewhere. So the first thing you want to do is come in here and get rid of that. I might have deleted too much. We'll see. No, I don't think I did, but I'm not sure where the where are my graphs coming from. So be careful that you don't delete too much, but I'm not sure where my graphs are coming from. Just a second. So you have a chart. Now, I guess it is coming off of these numbers. So you have large cap, high yield bonds. You'll probably have to edit this chart because this is something Bill Gates says really badly. I want to only show the label if there's something there. I don't want to show a label if there's nothing there. I'm sure there's some way you can do that in Excel, but I haven't figured it out. So you'll probably have to go back and add the labels back and delete the ones you don't want. I don't like showing labels that just say 0, like high yield. So, right. So I'm going to get rid of what's there because I'm going to rebuild that. So the first thing you can do is create a client. And this is where I'm recommending you have a client that's just really bad. So you can have something meaty. So let's say this is a client that's been pretty aggressive. They really like growth stocks because they've done really well recently. They like emerging and they like gold. So start off with your client. Just make sure whatever you do with your client doesn't exceed your constraints. All right. You got to change your constraints. So I'm not going to change these constraints because if I do, that gives you another set of constraints you can't use. So I'm going to keep it with 20, 10, 20, 40. 20 high yield is a pretty high constraint. You don't have to change all 4 of them. So high yield 20 is pretty high. Gold at 10 is a pretty standard. The last 2, it's all over the board. Some people don't have any constraints at all. If you have extra time, what you could do, which is really interesting, is run the model twice. Run it once unconstrained. We just make all these 100% and just see how different it is unconstrained versus constrained. We did that with USAA, and the constrained chart just nosedived because that's where we hit our max on real estate. So our model loved real estate, which was good because real estate did really well right after we did that. So we're kind of lucky. So let's say this is your client. So we're going to take this client and we're going to Control C And we're going to right click it and click on that 1, 2, 3. So now we got our client set up. So our client is very high risk with a return of about 766. Then what we're going to do is we're going to start running this portfolio somewhere around 4%. I don't know exactly the starting point we can do. You can somewhat tell by the graph, because the graph will tell you that it starts at 4. So I'm going to start at 4. Now, one thing when we do solver is if you're too far away from the starting point, you might want to force it to get to the starting point. So something I like to do is just say, let me put 10% in large or 20% in large cap. And I'll put the rest in bonds. And that gets me pretty close to 4%. So just give it a good starting point. And then I'm going to run solver. So data solver. I got solver set up. Y'all know how to set up solver, everybody? So Excel options, you set that up. Solver is a really cool tool to have. And when you set it up, it's already set up. So you're going to maximize return by changing these allocations, making sure all your constraints are met, making sure your allocation adds up to 100%, and then make your risk equal your target risk. When you get all those set up, then you let solver go. And you want the word found. You don't want converge. You want the word found. I don't know how many of y'all are going to try this on a Mac. Anyone's doing this on a Mac? So who knows? I have no clue how it's. Supposedly they forgot to put solver in and they threw it in at the last second and it wasn't quite good. Maybe they fixed it since then. I don't know. If it's not working, come up to school. It takes like 10 minutes to do this. So just come up to school and run it here, save the file and take it back home. But you want the word found. The word converge is kind of getting there, but not quite. So you run it and now you got 1 point. You can copy that point, Control C and paste it as values. And then we're going to do maybe 4.5. So what you'll find with the efficient frontier, it's got a nice curve to it at the beginning, and then it's like a straight line at the end. So there's some point where you can eventually just go about 1% and even 2, 3%. Once you get out to the end, you don't have to go 1, you don't have to go 0.5. But at the very beginning, you probably want some good points. So data, solve. It's converged. It's probably right, but we're gonna tell Bill Gates to try again. And when you do that, we're going to go back, put that point in, and you'll start noticing the efficient frontier is getting built. Now, if you do have a point that's wrong, you'll notice it really, really fast because your efficient frontier have a little bump in it. So if you have a little bump in it, you need to go rerun that point again because it can't have bump. It's got to be a nice smooth curve. So you'll know you did something wrong. And essentially, you just keep doing that until you get the entire efficient frontier run. And it usually goes pretty fast. It's not that difficult. Just keep running points. And you can see the efficient frontier just slowly building over time. I'll probably go 0.5% until I hit 6 and then start going a little faster. You're getting up there. Where are we on the allocation now? Boy, it's extremely high large cap growth. Yeah, my labels are way off. So, oh, that's the current portfolio. Sorry, I can say, well, that's a pretty high allocation. So, yeah, it's not showing it yet. I don't know why. So right now it's loves value, loves small cap, likes international. And obviously your bonds, you're starting from 80% bonds, we're already down to 68, but that's what you expect in a low risk portfolio. And that's pretty obvious. If it started off with stocks, we'd know we'd have a problem. So now I'm going to go up to 6. Now, if you want to write a macro to do all this, you can. The challenge with writing a macro, we use a macro at USAA, but the challenge is we couldn't find anything in Visual Basic that knew how to interpret found versus converged. So the best we could do Good old Greg Braun does for us. My first hire ever at USAA, and I hired him right out of my class at UTSA. He was in my class. We wrote the job description so that he was the only person in the entire company that fit the job description, because we knew his Excel skills are really good. But that's what he came up with. Hey, I can run a macro, but you have to bring up each point and hit OK, whether you want it to run again or not. So we couldn't figure that part out. So I'm sure there must be some way to do that. So I'm going to go up a little bit higher now. I'll go to 7%, just so we go a little faster, and kind of watch these allocations and notice how the stocks start allocating. It's still not doing large cap growth at all. That's probably good right now because they're overpriced, but that's not the reason the model's not doing it. I didn't put any tactical assumptions in here. So let's do 8%. Still no growth, but pretty well balanced with the rest of the stocks all the way throughout. Now my starting portfolio is 15%, so we're probably gonna have to change this recommended a little bit, but I'm gonna jump up to 10 next. It's probably gonna be a little bit much because it's gonna give us too much of a straight line. You'll be able to tell that in the graph, but we'll go and put 10 up there. So no, it's probably gonna be okay. And let's put 12 in there. Jump to 12.5. We're almost to the end here. I'll have students complain. I spent 40 hours on this. First of all, they probably spent 8 hours and they rounded up to the nearest 40 hours. But secondly, if you spend 40 hours in this, you're doing something wrong and you're not too wise, because you should have called me after 30 minutes, because after 30 minutes, is there any way this should take me hours? I'm almost done and it's taking me like 5 minutes. So it should not take you that long. Oh, I don't know what I just did though. I don't know why I did 12.5. Did I do 12 before?
Yes.
So I'll do 15. I don't know why I did 12.5. Y'all are probably wondering that same thing. You see me with my mistakes and I'm in front of y'all I'm still doing this in less than a few minutes. It just doesn't take that long. So 15%. And then the point I want to run is my current portfolio. So I'm actually going to put that in there. Well, I'll tell you what, we'll wait. Let's do, let's see, how high do I go? I'll go up to 18%. So let's go ahead and put 18 in there, just to get us in there. You'll probably run a few more points than that, so I wouldn't jump quite as much. And you'll be able to tell when I show you the graph, you'll be able to tell why you don't want to do that. So when we look at the efficient frontier, you can kind of tell we gotta jump up here a little bit. Let's make this 9 maybe. There we go. It's a little bit too much of a line. You can see. So, it's not terrible. It's not horrible, but it's a little weird. So you probably, I would go by 1%, but kind of use your judgment based on the graph. But one we want to do is the current portfolio. So I'm going to copy that and paste that as a value there, and then tell solver what's the highest return at my current level of risk, which is a pretty popular strategy for most people. So there that is. I'm going to put that in my recommended, and it is going to mess up my graph a little bit, but that's okay. So there's my recommended, there's my current portfolio. You can see how I kind of mess up the line, but it's not horrible. So I want to go from there with a 7.66 return up to here with an 8.25. So that's a pretty significant increase. Why? Because you see why I made my clients so horrible. This looks a lot better than if the dot were like right here. I could have had them way down here and moved them way up here. I could have had them way up here, moved them down here. You can do different things, but this is probably 80% of the class. They say, what's my current portfolio? Let me get the highest return on my current portfolio. As long as you start with a really bad customer. Now, some students don't start with a bad customer because they actually run their 401k plan. And if you do that, there's a good chance you're going to have a portfolio that's pretty close to the efficient frontier. But that's fine. You can say, hey, my client came to me with a pretty well balanced, pretty well efficient portfolio, which is perfectly reasonable to do as well. And then move these things around. Recommended portfolio, current portfolio, return, risk. Remember, do return using expected return, risk using standard deviation down here. Doesn't look much like an efficient frontier, does it? Looks like a straight line. But you can kind of tell my lowest risk, 4.5 and 3.5, 4.5 and 3.5. Bonds start right here, which means the line, if everything is perfectly correlated, would look like that. So it is bowed out quite a bit. You take, find that first point. It's not bad at all. It's shifting up, quite a bit there at the top. So first part of this, you say, here's my client. He's 80% stocks. He's got some gold. He's got some whatever. I forgot what I did. I'm recommending that he move to this. And again, I need to change the labels. Sometimes if you do it twice, it will do it. So if you undo them and put them back in, I want to add series name. There we go. All right. Oh, that's not good. Why does it say series? So, okay, but y'all know how to fix that. So y'all can fix the titles. That might be the hardest thing. That may be what your 20 hours are, getting that to work out, because I think Bill Gates has done a horrible job with graphics, not nearly as bad as Steve Jobs did, but they're both pretty bad, not very intuitive at all, but work on that. There's probably a way to, I can probably do it real fast. Select data and probably, well, there it is right there. So I don't know why it's not bringing it in. So, okay. So what are we recommending this client do? Well, right now, he has 80% of large cap growth. We want to move that down to 16 and add some large cap value. He's pretty well out of small cap entirely, so we're bringing in quite a bit of small cap. He doesn't like international at all, other than emerging. We're going to bring in, what do you notice about the international? You can tell we hit the constraint on that video, because nice round numbers. A little bit in bonds. In my opinion, 3.9% in bonds. Why even bother? Waste your time. It's one other asset class you got to monitor, and you're not going to notice it. But that's what the model says to do. No high yield. In fact, the model doesn't like high yield. The model doesn't like gold. But it's fairly well balanced with everything else. Pretty radical shift for this particular investor, but you would expect that with someone 80% in large cap. This is like that lady in my church I was telling you about, who that was her portfolio in 2000. Like give me tech stocks. That's the only thing that works. And I don't know how much money she lost. I didn't see her after that. All right, so pretty straightforward, and you argue your recommendation. You're stuck with my assumptions, but I don't think my assumptions are all that radically different from what you're going to find most other places. All right, so that's essentially 1/4 of the analysis, and I did it. What time is it? It's 7:53. So, and I talked a little bit about SVP at the beginning, so it doesn't take that much time to do. And you probably won't be talking to 40 people while you're doing it. You'll probably be doing it all by yourself, so it'd be a lot easier. All right. What I want you to do while you're doing this, we did this at USA. We're moving billions of dollars around based on this. So people use this. I want you to think, how rational is this? A good way to pick up a stock portfolio or any portfolio, investment portfolio. I like having well-diversified portfolios. Just feels right, even though I already showed you a presentation where I kind of question if that really diversifies your risk all that much, but I do like having a lot of diversification, but I'm not so sure these assumptions are the way to do it. I showed you how the model worked. So all of it's just, all the guts of it is down here. If you wanted to add another asset class, you can see the workload you'd have to do. You'd have to bring it in. This is the hardest part here, is bringing this whole thing in. But adding another asset class, you could. It gets a little tough. Real estate is the one people like to add. Real estate is tough just because the assumptions are so difficult. I'm using monthly data to build my assumptions, and there is no monthly data on real estate. You just can't find it. There is monthly data on real estate investment trust, but that's not real estate. Those are stocks. So you won't get good data. So really on real estate, you're up to you just have to just make up some assumptions and just go with it. Now at USA, we wrote an entire book on assumptions on real estate. But we've probably spent 3 months just on real estate. That's when we're reading articles, calling people on the articles. We did a lot of analysis on that. One thing we tried, which I thought was pretty cool, is we used REIT stocks, and then we tried to hedge out the small cap part of the REIT stocks to see what was left, to see if that was real estate. Didn't work, but it was kind of an interesting approach. But it's tough. Real estate is a really hard asset class to come up with assumptions. Also, mortgage-backed securities, which at that time, USA was like 60–70% mortgage-backed securities. They're very difficult to come up with assumptions. Because they have what? What's part of a mortgage-backed security? Anybody remember John's class or my investment class? What do they have? They have something embedded with them. Do you remember? Huh? Well, they have negative convexity, but why do they have negative convexity? Because they have embedded. I heard it. Embedded options, right? They have embedded options. Options are not normally distributed, are they? They're very skewed, and they're selling options, which is even worse. If you're buying options, you tend to cut off the tail. When you're selling options, you're tending to. So, you should have seen, and I was the only, it's kind of scary. I was the only fixed income guy in my department, and I'm not a fixed income guy. And so they were relying, here we have a company with 70% in mortgage backs, and it's my job to figure out what we're going to do. And my recommendation was 0. That was really fun. And I had the toughest time. It's really nice at that time. USA contracted with Dr. Misra. That I don't think any of y'all know Dr. Misra. He retired a few years ago. Great professor. You really missed out with him retiring. Great professor. But he came and taught a mortgage-backed security class at USAA, and I attended that. That helped a lot. But it's tough. There are some asset classes where it's just, this doesn't work really well because it's hard to get the assumptions they're just not part of this normal distribution type of world. So there are asset classes that are just very difficult. Stocks work really well in this environment. They give you pretty decent, you can come up with pretty decent assumptions. Then we'll look at the historical VAR. So here you have to pick a risk tolerance. So risk tolerance, the lower means you hate risk more. So a 60–70-year-old might have a 1% risk tolerance. A 20-year-old might have a 5% risk tolerance. All right, pretty subjective, but you just pick a number. And once you pick your risk tolerance, so if you use 5%, that's only 1.64 standard deviations. You pick 1%, it's 2.33. So you're talking about how far out in the tail are you worried about? If you're using 5%, you're not going very far out on the tail. So you're like really worried. You want to stay pretty close in. And 1%, if you use 0.1%, then you're essentially don't care about risk at all. I don't know when to hit escape and when not to hit escape. So Zoom is making it really difficult. So we're telling our customer, do what we say, and you'll end up with a higher return at the same level of risk. And our customer says the obvious question, well, how would that have done the last 30 years? Say, well, we don't want to show you that. We don't think you really need to know that. How did it do? Much higher return with a little bit more risk, but not dramatically more risk, but more risk. So we just even say, we told you we're going to get higher return at the same risk. What we actually going to give you is lower return at lower risk. If it were historical, but yeah, It's awkward, isn't it? Do you see why they never show you this? Now, why is that the case? Because he had 80% in growth stocks. What's done really well the last few years has been growth stocks. So this is just the time growth stocks. So maybe you can use the argument, growth stocks have done extremely well recently. This is probably a good time. You can use the efficient frontier as a good excuse to move out of growth stocks and allocate somewhere else. But no one ever does this, but you should always ask for this. When someone gives you a recommended portfolio from your current portfolio, say, I want to just see how that works versus history. And then if they can't explain the differences, because this is going to happen a lot, it's very rare that they're going to recommend you have a high allocation to the thing that's done the best. Almost always their allocation to the thing that's done best recently is going to be lower. And so, there's a good chance if you had a high allocation there, and a lot of people do, because a lot of people chase returns, there's a good chance it's not going to look as strong. But see what they say. I mean, this is a good chance to see how financial planners do. This one lady I was helping, they messed something up, so they gave her a free financial plan, and she had me sit down with her to explain it. And their recommendation was, if stocks are going up, you should be in stocks. If they're going down, you should avoid stocks. And her question to me is, what's a mutual fund? Because they recommend her to use mutual fund. It was completely worthless, but it was free. She got a free plan, and she overpaid for a free plan because it was worth less than nothing. But they spent no time with her at all. It was pretty embarrassing. I was kind of embarrassed that my industry gave her that. They should be giving you stuff like this. They should be confidently saying, hey, we know our returns look lower than history, but here's the reason why, and confidently go into it. That's your goal in the paper. You cannot in the paper say, this is because my idiot professor came up with the assumptions. I had no control over that. When you're presenting your firm's numbers, you got to put the best face on them that you can. All right. So you got to make me sound smart, because you're stuck with my numbers. All right. So find some way to justify this. This section of the paper usually is only 2 paragraphs, maybe with this table cleaned up and put into the paper. Usually only 2 paragraphs. So I'm really looking to see if you can come up with a good explanation for what's going on. You can maybe do a little extra research to see what's going on. All the numbers you need are in this file, and you can easily find them. In fact, it's right over here to the side. You can see each of the asset classes are in here. If you wanted to look at some of them and see what was going on, you could certainly figure that out. So that's just a kind of a gee whiz kind of analysis. And then the style analysis, I'm going to use the Vanguard VWELX. So let me show you what we have to choose from here. So I brought in some mutual fund returns. Fidelity balanced FBALX. So when you see the word balanced, what does that mean? Stocks and bonds. We don't know how much, but it's going to have some stocks, some bonds in it. You look at the profile of this thing. Pretty significant management fee, 52 basis points. That's a pretty expensive fund. Somewhere in here they will tell you, maybe it's on their holdings. Stocks 70, bonds 23, cash. It's essentially a 70-30 portfolio. 2.38 in other, who knows? But what is that? So you'd want to know that. Is it large? So that's what we're going to try to figure out. Is it large cap? Is it small cap? Is it growth? Is it value? How much international? We'd certainly want to know that. One thing I recommend you do is, once you find the fund that you're going to do the analysis on, go to the prospectus and see if your style analysis is consistent to what they say they're holding. You can see it's not really giving us enough information here on large cap, small cap, and those type of things. Now those, I don't know, any of y'all were here Wednesday night or Tuesday night when Michael came in. But I probably give someone a few extra points if you win in the Bloomberg portfolio and It's hard to do with the mutual fund, but if you can find an ETF that matches a mutual fund, you can do some amazing analysis. So you could, maybe I would even give like a 10% bonus if someone did that, because it would not just help you on your grade, but help you in life and getting a job, because that's a really powerful tool. Or if you don't know how to do it, come catch me, because I want to figure it out as well. We'll figure it out. And if not, I'll call Michael and he'd be here. Like, he'd probably take him 3 minutes to get here, but he'd come up to help. He loves the stuff as well. Credit, that's the other thing on the bonds. I want to know, is it treasuries? Is it corporates? Is it high yield? What's the duration? Is it 5 years, 10 years? There's a lot of information. We don't have that in our attribution. That's something though that the Bloomberg portfolio can do for you. It can show where are you, what are your sectors? So they do show the sectors. So that's kind of interesting, pretty heavy in tech. So it kind of implies that this is somewhat of a large cap or a growth kind of focused fund. But that's what we want to try to figure out. I don't know what they have on risk. I've never clicked on the risk. It's a 4-star rated fund. What does 4-star tell you? Nothing. I used to ask that question, Michael, back to Michael. Michael, what value is a Morningstar rating? So I asked them, go out and get a Morningstar ratings from 5 years ago. Take 5-star rated, 4-star, 3. Tell me how they do the next 5 years. Zero correlation. 5-star funds do no better than 4, no better than 3, no better than 2. Only exception was 1-star funds do horribly. But 2, 3, 4, 5-star funds do exactly the same going forward. Why does it have a 4-star? Because it's done well historically. But that doesn't mean it's going to do well in the future, and there's zero correlation. So the reason this bothers me is a lot of these CPAs have opened up their financial planning departments, and all they're doing is buying mutual funds based on Morningstar stars and whatever kickbacks they get. So they're doing something that has no value to their customers. Are they going to put their customers in 2-star funds? No, you're not going to do that. Put them in 4 or 5-star funds, but it doesn't improve performance whatsoever. There's no correlation between Morningstar stars and actual stock returns going forward. So these funds should have quite a bit of information. You can go to their website and get the actual prospectus, and everything is in this prospectus. You probably can get all of their holdings somewhere. That's something I don't know on Bloomberg, on mutual funds, I'm not so sure of. Definitely on ETFs. That's the thing that shocked us Tuesday night. We brought in an ETF, and within a few seconds, every single thing they own and how many shares of each that they own came in a nanosecond. It was it's shocking to me. I thought it was going to take it a few seconds, but it didn't. It just came right on in. So all these ETF holdings are they're available, public information, come right in. It's possible with mutual funds as well. I'm going back to 87. So what about 97 or 77? So about 35 years. So pretty good history there. Starting with high interest rates. Some pretty good stock markets in the 80s and 90s. 2 pretty good bear markets in there. Maybe 3 good bear markets in there. So what you have to do is pick one of these. So let's pick one. We're going to pick these 2 green ones. Are these in the green? You can't pick. So why can't you pick these? Because these are ones I'm doing. Right? So you can't do those. So, but I'm going to do the Vanguard VWELX. So make sure it's the same. VWELX is in column AX. So I'm going to come down here and change this to AX and copy it down. So now I got my mutual. All right. And I'm pulling it from Bloomberg. Bloomberg has a total return index gross of dividends. And so what it's doing, the gross means it's not making an adjustment for taxes for the dividends. This includes the capital gain distribution. I still don't think, just looking at what we saw in Vanguard and Yahoo Finance, I don't think While Yahoo Finance is now showing you the capital gains, I don't think they're adjusting for them. So I still think it's understating returns. So this should give you the true return on this mutual fund, which is what you want. All right. So when we bring that in, now we have monthly returns. And so what we're going to do is we're going to tell Excel, you have all these asset classes over here. What allocation to all these asset classes, to the returns of the asset classes, will give me the highest R squared? Essentially want to know what allocation to this asset classes best explains the volatility of this Fidelity or this Vanguard fund. And so let's say I started off 20, 20, 10, 10. This is what I just thought it was. That gives me R squared of 84. So I don't know what's going to be in there. Probably whatever I had for Vanguard is going to be in there. So I'm going to do solver. And again, solver's all set up. I want to maximize the R squared by changing these allocations, making sure they add up to 100%. Real simple. See how long it takes Bill Gates to do this. Pretty fast. Got a 95% R squared. You look at the chart, you can see that the Vanguard fund has done very well. But you'll probably see something like that. But one of the reasons you're going to see a lot of your funds do well is I'm picking funds that are pretty famous, which means they've probably done pretty well. So I'm kind of giving you some of the best funds just because I want to. So that looks like a pretty good fund. It's telling us that yes, it's got large cap, but it's really skewed toward value. Now, what did it look like when I looked at them on there? They had all that tech. So this, oh, I'm sorry, this is V. Let's look at this particular one, VWELX. So it says it's 66% stocks. Mine says it's how much in stocks? Let's go see. I can't remember. It's mine says 55%. Nope. Did I miss something? Yep. Mine says 55. Mine says 55, 45. This says 65, 35. There's something missing there, isn't there? That doesn't add up to 100%, does it? So, yeah, there's something missing. So you'll probably have to go to their actual prospectus. So I picked a fund that Yahoo Finance doesn't do very well, but you go to their actual prospectus, which is not that difficult to do. Vanguard. Someone's got to get a job at Vanguard. We don't have a single UTSA alum at Vanguard. Can any of y'all work in the cold of Pennsylvania for just 3 years? You got it. All right, go apply for a job there. My favorite firm, but they've never hired a UTSA student, so how can they be any good? Okay. What we offer, I want to see our mutual funds. Where are they, mutual funds? You all. So this is a balance, so you can probably find it. Let's see if we can see here. Balance VWELX. There it is right there. Oh, it's the Wellington Fund. The Wellington Fund, boy, it's been around for some time. I don't know that they tell you when it was initiated. Yeah, there we go, 1929. This is one of the oldest funds out there. So you can do portfolio composition. They say 66-35. I'm getting 55-45. So we're getting something pretty radically different. Not sure why. Fixed income. They give you the yield of maturity. They don't give you the credit quality. I don't think. It doesn't look like. The duration's pretty long, 6.8 years. They've got 1,200 bonds. That's a lot of bonds. They don't have 1,200 bonds in this portfolio. They have 1,200 bonds in the mutual fund this portfolio is purchasing. So this is really a fund of funds kind of thing. But 1,200 securities, 4.7% yield. The 10-year treasuries below 4%, so it's definitely got some corporates in it. So interesting. The stock side, yeah, it says large cap value. That's that part looks consistent with what we had. Definitely had a value bent to it. The duration, medium duration, I think that's pretty long duration actually, and investment grade corporates. So the big disconnect with what we have and what they're showing is we're 65 and we're 55 and they're showing 65. I don't know why that is. That somewhat explains why they're so outperforming in this, because they probably have more stocks than we're showing. So I'm not sure what the disconnect is. It's kind of interesting. Didn't look like they had high yield that would bring that in, but it is what it is. It's the numbers. 95 is a pretty good explanatory. So what are you going to tell your client? Well, probably what you want to do is compare this, and what a lot of students do is they build a pie chart of this and compare it to what they're recommending. And what they're going to say is, hey, you know what? This allocation is pretty significantly different. We're recommending overweight growth, and plus our portfolio is pretty heavy in stocks. This portfolio is overweight value, so just by that yourself, you can't use this portfolio. So you're going to kick it out. Doesn't make sense. All right, so not a good portfolio, but you'll see this in the video. One thing I get this every single semester. We'll see who in this room will be this person. If anyone wants to, bet on someone. So we'll see who doesn't take good notes. Somewhere like the week before this is due, someone's going to give me I spent 30 hours on this email. Professor Sweet, I tried as hard as I could, and I couldn't find a mutual fund with a correlation of 95%. I never said you had to get a correlation 95%. 80 is fine. 20 wouldn't be good, but you don't need a correlation of 95%. But someone in this room is going to call me, Professor, I tried like 70 different mutual funds when they tried 20, but they, rounded up to the nearest 70. So no, I don't need that. Why does this one get such a high one? Well, it's Vanguard, so it's already fairly indexy to begin with. I don't understand the 65 and 55, which is kind of strange. Now it's not entirely Vanguard. I take that back because it is the Wellington. Wellington is a fairly active portfolio, so that may have some explanation here. They may have changed their allocation pretty dramatically. So over time, maybe it was 55, but right now they're 65. So if I probably should have picked a different Vanguard to do. Let's try another one, but we won't count this against you. So you can still do this one if you want. Let's try the Fidelity, since we're just looking at that one. Professor, I can't do this one. I only got 93. You told us we had to get 95. Right? That's the email I'll get. So 93%. Look at the style chart. They've done pretty well here recently. It just really kicked it pretty well. But what is the allocation? It's still overly valued. They're 62%. I forget what Vanguard's Yahoo Finance showed us. $70.30. So again, we're getting, for some reason, consistently lower, but so we get 62, they get 70. And that may be why they kicked out here at the end as well. This might be a thing of all these funds went heavy stocks after COVID. And so that's why they get that big kick there at the end. But that's what you're looking for here. This is the style analysis. Many of you in your first job will be doing style analysis and fact set, but you're going to do it by hand in Excel, so you have a much better understanding what fact set's doing. This is exactly what fact set is doing. Is it's just finding the highest R square to get you these two funds as similar as possible. Make sure to change your fund name up here, and then your chart should be fine. I think it automatically updates the chart. I can't remember. If not, you'll have to do that. All right, fairly straightforward stuff. All right, so I think everything I just did, you probably could have done all three of those in 15 minutes. Not the writing and the thinking about it, but just getting the data should not take you that long. All right, this is pretty simple stuff. This next one is the attribution, and this is where Bloomberg will do a whole lot better job than what we're doing here, because I don't have all these sector information, and I can't tell you, and there's the contribution of each stock to the return, which is just a powerful thing. So I would allow someone to substitute Bloomberg portfolio for this part of the paper and just use that as their paper if they want to, because it would be much more valuable to you than what we're going to do here. But let's do a mutual fund. I'm going to do the contra fund, so you just go find it. The Fidelity contra fund, I'm not going to do another one. You go find their total returns. And this is really material, because they paid really significant capital gain distributions in December. And if you don't, like you can see in this December, it shows that the price actually went up, but if you use it from Yahoo Finance, it would actually have come down. So it's pretty material of difference. So I'll bring that in. The next thing I'm going to do is I've got two columns here. So you always want the S&P 500 because we're going to calculate a beta. So we need that. But the contra fund, is it a value fund or is it growth fund? You can actually test it by bringing them both in there. So here I have value. So I went over to the asset returns, pace values, and I found large cap value is in column E. So you can just bring in column E. And then you can do a correlation between the contra fund and value stocks. You can see that correlation is 0.82, and then you could try the same thing with growth stocks. It doesn't take very long to do it. And there you see the correlation is 0.9. So it looks like growth is the better benchmark to use than value. You'll see how I do that. So you've got all these asset classes over here. So is it large cap? Is it small cap? Is it growth? Is it value? You've got all that in here. The key with the mutual fund, with the manager attribution, is they need to be in one asset class manager. They could be core, which is large, value and growth, but you don't want a global stock fund that has U.S. stocks, non-U.S. stocks. That's not going to work here. This needs to be a one asset class analysis. So I've got the contra fund in there. I got their returns. And you can see how on the video, you'll see how I did the rest of it. So I get their returns, the S&P 500 returns, whatever I think their best benchmarks return is. I then link the returns. And I do that by taking $1 and adding the return and just linking that. So $1 at the end of the time would have been $82. And then I'll do their alpha. Their alpha versus the S&P is just their return minus the S&P, and their alpha versus a growth manager from growth index. And then I count if they beat the S&P. And then I did upside and downside. You'll see this in the video. It shows you how to do that. So what I do here is I say, if the market is greater than 0, give me Fidelity's return. Otherwise, give me nothing. On the downside, I say, if the market was negative, give me Fidelity. Otherwise, give me nothing. For the market, I say, if the market's positive, give me the market. If the market was negative, give me the market. So it's possible, like right here, the market was up, but the contra fund was down. But I'm defining that as an up market. All right. So that's really important because that was an up market. So we're letting the market define what's up or down. I don't know if we have any where the market was down and Fidelity was up. Yeah, there's one. The market was down almost a mirror of that other one. So they made it all up in 1 month. So that's what you'll build. The video will walk you through how to build all of those. So that's just some basic stuff. And then at the bottom, what we're going to do is the analysis. So we're looking at 422 months of data. That's a lot of data. We then do the geometric average. Geometric average takes that ending value divided by 1, raise it to the 12 over 4/22 minus 1. So you should have done this like in your investments class. That's just the annualized return. They have materially beat the market. If you pull this from Yahoo Finance, they would have underperformed the market. That's how material those capital gain distributions are. So they go from a negative alpha to a positive alpha. So don't penalize them for those 5% returns, the distributions they do every year. So very, very strong outperformance. And this is a good fund. We had the contra fund in our portfolio for years. Very interesting fund. I'm not a big Fidelity fan, mainly because I just think they have too many funds. But when I first took over equities at USA, one of my first presentations was to show USA versus Fidelity. USA had one growth fund. They had like 72 of them. And I was like, you have one fund. Now, the disadvantage is if that fund's not doing well, that's the only one we have. The advantage Fidelity has is if they have 17 funds, they just market the 3 that are doing well, which is really, really bad to do, but that's what they do. Or if they have 4 that are really doing badly, they don't shut them down. They just slightly change the strategy and all of that history disappears. So that 2-star fund becomes no stars because it's a brand new fund. We debated doing that at USA and was like, no, that just seems too unethical. We're not going to do it. But it's pretty common. If you have 17 funds, you always have 3 or 4 funds you can market. So that strategy makes sense. But my argument with our sales floor is, boy, that's confusing. We got one growth fund. Here's what we have. Market that. We have one value fund. So I just prefer that. It made a lot more sense.
Yeah, actually, like half Fidelity fund, and I agree that there's like so many.
Too many. And you notice a lot of people are just looking at history and picking the one that did well and just chasing performance. But it's not just the investor though. It's the Fidelity. I mean, Fidelity came in to talk to us. They show us these funds and boy, they had great performance. We're like, why aren't you showing us that fund? Oh, well, recently they haven't done well. It's like, well, that's probably the one we want. But no, they push the ones that have done well. So they complain about their customers chasing performance. And then that's what they do when they market it. Because it's so much easier to market a fund that's been doing well. It's just, I mean, it's kind of just, it pays the fact if you're a salesperson. The standard deviation, y'all know how to annualize standard deviation? You don't take the monthly standard deviations times 12. What do? Monthly standard deviations times square root of 12. Now remember that? You can annualize volatility. So you can take volatility times 12 and take the square root of that, or you multiply standard deviations times the square root of 12. So yeah, so there's the annualized standard deviation. They've done well on that too. This is a really good fund. I mean, I'm picking funds that have a good history because they're famous. Plus, I need funds that have 35 years of history. It's hard to find really horrible funds with 35 years of history because we're more marketers than we are anything else. Growth funds are pretty volatile. So this fund has done well. I call it a contra fund, so it kind of implies they're going against the grain of what everybody else is doing. So that kind of implies that their risk could be lower. Their monthly risk, their alpha is just 13% minus 10 and 13% minus 10. Their tracking error, remember the tracking error is just the standard deviation of that alpha. Their tracking error versus the S&P is lower than it is versus a growth fund. And their information ratio is really, really good. Anything above 1 is considered exceptional. You can see why we had this fund in our portfolio. It's a very, very good fund. I don't think I gave you all the Magellan fund, but certainly I may have. I don't remember. Boy. So the funds I gave you are the ones in whatever this color is, peach, whatever. I don't think I gave you Fidelity, Magellan. If it's a mutual fund you want that's not in here, I'll add it. You just let me know, or you can go get the data yourself because I left I left the mutual funds. No, I didn't. It's actually a separate file, so you'd have to, it's everything you need is in there. You'd have to build your own formula, but everything you need is in there. But I'm using, this is the most important thing right here. This is what you need. This thing right here is what you need in Bloomberg to get that total return. This is something you should all write down. This is really a powerful little function in Excel because you can't, I mean, in Bloomberg, because you can't do this in Yahoo Finance. To get a true total return, especially if you're talking about mutual funds or ETFs or those type of things, you really need to use that function. It does a great job. And I do gross of dividends. I don't do net of dividends because I'm not really sure what tax assumptions they're making. So I don't have the Fidelity fund in here, but I've got some pretty good funds for you to choose. Dodge and Cox is pretty famous. Probably most of the funds I picked have done well over time. All right, so they get a high score. This is a great. So if your customer came to you and said, "Hey, you said I need some large cap. I've got a large cap manager here. He's kind of a growthy manager. Can I use this manager?" You look and say, "Yeah, this manager's done pretty well. You probably could use this as part of your growth allocation." That would make some sense. And they like that because they don't have to sell it and buy something else and incur all those taxes. So that's kind of nice. So yeah, there you go. Their batting average is 57. That sounds pretty good. That'd be pretty good in the Major League Baseball, wouldn't it? Anybody batting 57 in the Major League? So that's pretty good batting average. Although here 50% would be mediocre, so it's making it about 57 is a very good batting average. Their upside capture, they get almost all of the upside of the market, but they're pretty good at avoiding the downside of the market. So that's good, and that's somewhat consistent with their risk being lower than the other two.
Is that like Excel file on Blackboard?
Yeah, it's on Blackboard under the files for the projects.
I'm looking at files.
Well, I thought I put it out there. Maybe I didn't. I'll put it out there tonight when I get there. All right, so downside capture. What's their beta? So y'all know beta equal slope, and what do I highlight to use beta? S&P first, Fidelity first, Fidelity first, and S&P. Now, what would you guess their beta would be? You have some hints that they're lower risk. Does lower volatility always mean lower betas? Not always. They look like they're a little growthy, which somewhat implies a little bit higher beta. It's hard to say. Their downside capture is lower, so that's kind of supplies. So yeah, this is a fairly low beta portfolio. Now, I don't know if Yahoo Finance gives. I can't spell Fidelity. Let's see what they give us. See if they give us a beta. They had the beta right at 1. That's just the last 5 years. We're doing the last 35 years. The last 35 years, their beta is 0.88. This may be another example of fund that's got more aggressive after COVID. Who knows? COVID, there's some great opportunities because of COVID that people are taking advantage of. Then when you do Sharp and Jensen, you will have to bring in the risk-free rate to do that. How do you do that? I just go out, I type H51. I won't do it here. I want y'all to do some stuff on your own. I just do H15, bring in the historical, and I just use like a 3-month treasury T-bill or a 6-month T-bill. And just use a yield, and that monthly average, that's what's going to be my risk-free rate. You can do something that simple. It's perfectly fine. And then for the trainer, you've already got the beta, so you can do, or no, I guess it's the Jensen that needed the beta. Boy, I can't remember. No, I think all 3 of them needed the risk-free rate. Now that I think about it, I can't remember. We never use these in practice, so all I can remember is the Sharp. But you got the formulas out there. If you want to try the Sortino ratio, you can certainly try that. You'd have to figure out how to do the semi-variance. It's possible. Excel has a semi-variance function there. I don't know how you would do it. Semi-variance equals semi-var. Nothing's coming up. So I don't know if they have one. Semi-variance in Excel. how to calculate 3 simple methods, so it doesn't look like it's there. You know, y'all are far more computer savvy than I, but I love it when a student says, "Professor, I don't know how to do it. I've looked everywhere," and I do that. It's like, well, there it is. And it's like, oh, I didn't think to type that in Google, but you can just type it in Google, and it's amazing. Everything's out there. Probably there's a YouTube video that shows you like this. So semivariance is possible if you want to do Sortino. Sortino is interesting because it just sounds so cool and sophisticated. I doubt it's all that predictive or help you outperform the market, but it certainly could be interesting. So you see the project, your first thing you're trying to do is get a recommendation of asset allocation. Pretty simple. You're going to talk about your client for a few paragraphs. Who are they, their age, what they're investing for, how risk adverse or not, if they have any biases against certain asset classes. The second thing you're going to do is talk about the assumptions that you got from your professor, what your constraints were. You spend a little time on the constraints. So now you've set everything up. Next thing you can do is this analysis, an efficient frontier analysis, mean variance analysis. You can have a chart like this, you can have a recommendation. There's a lot of things you can do here to make it more advanced, but you can keep it fairly simple if you want to. Then you're going to do what no one does and actually have the guts to show your recommended portfolio on a historical basis versus the current, which is always kind of scary to do. And then you need to have some explanation that a client would buy for why it's so good. Now you may get lucky and your portfolio actually does better than your client's portfolio, and it makes it a lot easier. But there's a good chance not, mainly because of international stocks. Growth stocks, you can tell this model doesn't like growth stocks, and they've done really well. That's probably a main explanation. And then bonds. Interest rates have been falling. Bonds are going to do a lot better historically than we're going to assume them going forward. So those 3 things are going to have some of an impact. So a couple of paragraphs on historical VAR versus parametric VAR. Then you're going to do a style analysis. Your client comes in with this mutual fund and they're asking you, can I use this mutual fund? And your answer is going to be what? No, you can't, because the allocation is too different. I ran a sophisticated, you got to throw those words in. Sophisticated. I have a sophisticated proprietary quantitative model, and I do these style analysis. And based on that, I got an R-squared. I could, explanatory power 93%. And based on that, this portfolio doesn't meet criteria. And your client says, well, why didn't you just look in the prospectus? It's like, no, I want to do it much more sophisticated than that. And then the last thing you do where your client says, okay, well, if I can't use that mutual fund, I've got a large cap mutual fund I really like. I've had this for years. I don't know if it's done it well or not because I don't know how to do all this, but can you put this into a fancy model? Or if you're really smart, put it into Bloomberg and tell me if I made a good decision on this particular portfolio. And you can pick other funds than what I have here. You can either email me other funds you want to do. You can email me your 401k plan, your parents' 401k plan, and we can use some of their target funds. I can usually figure them out. They usually have pretty good, most 401k plans have pretty good prospectuses that tell you what's going on. There's sometimes where they have something we can't model because we don't have it. So it's just, if you got someone with TRS, it's pretty amazing what they have. They do have actual true real estate as an investment. So there are some allocations out there that we can't do with this, but there's a lot of them we can match. And you may have a 401k that has actual individual stock portfolios. Some of these funds might be in there, or if not, we can add them in there. A lot of 401k plans, they have an option that has a parallel 1-for-1 mutual fund match. That you can go get the mutual. They may not call it that mutual fund, but they may say call us a Fidelity whatever, and we can go find the ticker for that particular Fidelity fund. So you can do some. This is not as sophisticated as you probably want, but it's getting pretty close. If you want to get really sophisticated, on this part, use the Bloomberg or use FactSet. But I think you have a huge advantage doing it yourself and seeing how the math works, what the data looks like. And then when you're doing it in this black box of FactSet or Bloomberg, you have a better understanding of what's going on. The nice thing about FactSet and Bloomberg is they give you a whole lot more stuff than this. So what will Bloomberg give you? We talked about it last class. What sectors are you in versus the market? What stocks actually gave you your outperformance? You wouldn't go back 35 years to do that, but you can go back 3 years and say, hey, here's the, and I always love it. Here's the top 10 performing, the top 10 contributors, the top 10 detractors. Here's the top sectors that helped us. Here's the sectors that hurt us. It's really, really cool analysis. It helps the portfolio manager quite a bit because sometimes they're taking bets they don't know they're taking. You can tell them, hey, you realize you have a pretty strong over allocation of communication services. Do you know you're 5% above the benchmark on that? And they may, I didn't realize they moved Meta to communication services. Oh, okay, wow, that's a big deal. So, those kind of things your analysis can bring up. There's a good chance 5, 10, 15, 20% of you, this will be your first job. This is a pretty common job. Kind of that back office. My first job in investments was in the trust department, USA. I mean, in the investment company. I was in investment strategy before that, but in investment company, USA was expanding their trust department. They needed an analyst, and that was my first job. And it was a small operation, so they had nothing. I was their entire IT department, which was Excel. I had Excel. And so they're having me, and we didn't have any new stuff. I was doing everything by hand. It was amazing. If I'd had Bloomberg portfolio back then, my boss would have thought I was some alien from a foreign planet because there's no way we could have done stuff like that. So you have a whole lot more tools at your fingertips. If you want to get a job that pays 150 instead of 80, then learn them, and then you can get a much better job because employers love entry-level people that can step in and just start doing this stuff. That's one thing Goldman told me. He says, "Boy, we love your investment society members because it's like they've been working for 6 months." And we get these grads from Stanford and Yale, and they don't know anything. We got to train them from scratch. In fact, we usually have your investment society people train them because they don't know anything. It's a huge advantage. You don't have to be an investment society, but the advantage of that is give you a lot of Excel and Cap IQ, or you can teach yourself. So learning this stuff. So I would encourage you in this project, all you got to have after this first paper is you got the exam coming up, and then you got this project. So if you want to get down and we have the 6 o'clock class on Tuesday, which is going to go into the Bloomberg portfolio. We're going to take what Michael showed us. I'm going to actually now, if you can't make that class, I'm going to take Michael's class and I'm going to put it as a YouTube video on the Investment Societies University website. I'm going to have to bring it down because fortunately he made some mistakes, which was good because it made him have to do stuff again. So I could see it again, what he did. It's one of those software packages you've probably seen where you watch it and go, hey, I could do that. And then the next day you try and it's like you've never seen it before in your life. So it's one of those, the buttons are not obvious what they click. So with Michael there on the side, it'd probably be about a 25-minute video. You could do this. So I encourage you, step out of your comfort zone and do more than just what the assignment asks for. I'll put this out there on Blackboard tonight. All right, that's it for me.